today under our BITS economic topic we are discussing a very important topic, and surely you expect a question either from base erosion and profit shifting or from double taxation avoidance agreement which India have recently amended, or from this instrument what is called as multilateral instrument. Okay, so from any of these area there is a high possibility that you will get a question. Okay, so if you are aware of the concepts as well as the current affair associated with it, you can easily answer it. Now today's topic is about a convention, a very important convention which India have signed in June 2017. So the time period is very important. So this was in news in June 2017, and almost in the entire year of 2017 this something associated with tax evasion was in news. So this convention which India and more than 100 countries signed in June 2017 have become very important for your coming prelims. Now, so what is this convention is all about? Okay, so if you read the convention name itself, you will get some idea about what this convention aims at. Okay, it's a convention is about, it's called as it's a lengthy name, multilateral convention. So it's a multilateral convention, so more than 2 or more countries, so it's nearly 100 countries are involved in it. So it's a multilateral convention to implement, a convention to implement tax treaty related measures to prevent BEPS. So it is a convention, multilateral convention to implement. So here two terms you need to be very, you need to understand. Okay, to implement tax treaty. So what is tax treaty here? Tax treaty is nothing but we already discussed. It's nothing but double taxation avoidance agreement signed. It's a bilateral tax treaty, or mainly bilateral tax treaty signed between two countries. We call by another name is double taxation avoidance agreement. Okay, so to implement, so it's a multilateral convention to implement tax treaty related measures to prevent base erosion and profit shifting. BEPS is very important for you. Already in 2016 UPSC have asked a prelims question on what is this base erosion and profit shifting. Okay, now so you need to understand that there is a relationship between tax treaty and base erosion and profit shifting. Base erosion and profit shifting, in simple term, understand that multinational companies shift their profit to some, by showing that okay, this profit have means main source of their profit is not from a high tax country but from a low tax country, mainly tax havens. So when, even though multinational companies, their main source of income will be from a country like India, but when they show profit, they will show that the profit the major source of profit have arrived, is derived, or it has occurred from a low tax destination country. So this is actually profit shifting. So BEPS is profit shifting by a multinational company to a low tax income country so that they can pay less tax. So, but for the source country like India and other developing countries, and not only developing countries, even developed countries also, which is having high tax, so those countries, their tax base will erode. So this artificial shifting of profit by multinational companies resulting in tax base erosion, that is what is called as BEPS. That's a simple concept. So how this base erosion and profit shifting is related to tax treaty? Because in most of the tax treaties there is a provision for avoiding double taxation. So what multinational companies will do is that they will misuse this tax treaty, where in some tax treaties will have already provided for residence based taxation instead of source based taxation. So if I take the case of India-Mauritius tax treaty. So India-Mauritius tax treaty, due to India-Mauritius tax treaty, we have Indian government or India have lost lot of tax, in the sense that in the earlier India-Mauritius, I am not talking about the revised India-Mauritius tax treaty, in the earlier India-Mauritius tax treaty, it was residence based taxation. So the Mauritius company, multinational companies based in Mauritius, they will not pay tax in capital gains tax in India, only they will pay in Mauritius, because the tax treaty says that the tax is residence based. I am talking about capital gains tax. So even though the income is generated in India, but under this tax treaty, they will pay tax only in Mauritius, because whereas the residents of the Mauritius entity, they will pay tax there. But in Mauritius, there is no tax at all, because Mauritius is a tax haven. So these multinational companies will not pay tax in India, as well as they will not pay tax in Mauritius also. So they are misusing this tax treaty provisions. So what the Indian government have done in May 2016, they have amended that tax treaty protocol. Means tax treaty, through an amended protocol, we have revised that tax treaty. So you can expect a question on India-Mauritius tax treaty, or India-Cyprus tax treaty, or India-Singapore tax treaty. All we have amended it. So what I am trying to say is that, so misusing of tax treaty have resulted in base erosion and profit shifting. So countries like, see, it is not only an initial concern for the country like India. Almost every even developed country which is having a higher tax rate, they are also concerned, because every government is losing revenue because of this base erosion and profit shifting strategies done by multinational companies. So in order to tackle this problem of BEPS, mainly through treaty abuse means tax treaty has been abused. OECD have, in association with the G20 countries, so India is a member of G20, so that's a very important point. In association with G20, have come with a project, BEPS project. So the basic aim of this BEPS project initiated by OECD and G20 is to tackle tax evasion as well as base erosion and profit shifting by multinational companies. As part of this initiative, means aim to prevent this BEPS, this OECD G20 country have come with a BEPS project which consists of 15-point action plan. So this BEPS project consists of 15-point action plan, and so you can say that this convention, this is a very important point, okay, this convention is an outcome to implement this OECD G20 BEPS project. So this convention is an outcome to implement OECD G20 BEPS project to tackle what? Base erosion and profit shifting by multinational companies. Now try to understand that. So if you want to prevent BEPS, we have to, means every country have to amend their tax treaties, because the major the problem lies in these tax treaties. So if the OECD want to, this BEPS project have to be implemented, nearly 3,000 bilateral tax treaties have to be amended or changed. Okay, so in order to successfully implement this BEPS project, nearly 3,000 bilateral tax treaties signed between many countries have to be changed. So in order to avoid that, this is very important. Okay, so final BEPS project consists of 15-point action plan, and if you want to implement this, you need to change something around 3,000 bilateral tax treaties. So this convention, here lies the importance of this convention. So this convention is conceived as a multilateral instrument. Okay, so in short form it is called as MLI. MLI is multilateral instrument. Okay, this convention to implement tax treaty related measures to prevent BEPS is conceived as a multilateral instrument. That is what is called as MLI. It is conceived as a multilateral instrument, so that instead of making changes to 3,000 bilateral tax treaties, what it will help is this one single instrument will swiftly modify all the covered tax agreements. Okay, so this word is very important. Okay, so UPSC can ask this. They'll ask you what do you mean by covered tax agreement, or why covered tax agreement is in news. So covered tax agreement is nothing but it's a bilateral tax treaties. So India Mauritius tax treaty, India Singapore tax treaty, then India-Cyprus tax treaty, they are all covered tax agreements between India and some other country, because these are all bilateral tax treaties. Okay, so what this convention will do, or this instrument, so this convention is conceived as it's an instrument, multilateral instrument, so that instead of making changes to all these nearly to 3,000 bilateral tax treaty, by using a single convention, by asking the member countries to sign this, to ratify this convention, you can swiftly modify nearly all these covered tax agreements to implement. So in order to implement BEPS, we can swiftly modify all these covered nearly 3,000 covered tax agreement by, if all the member countries, all the countries who are having bilateral tax treaty, if they sign and ratify this tax treaty, it become easy. So no need to make changes to individual tax treaty. Instead of that, you become a member of this convention. So that is the basic aim of this multilateral convention. Okay, so this multilateral convention will help the member countries who become a part of it, so that by becoming a part of this convention, every member country need not to make individual changes. It will be automatically covered with by becoming a member of it. So that is a very important point to be noted down. So in order to implement this multilateral instrument, okay, in February it was decided by G20, OECD and the associated countries of BEPS to form an ad hoc group in February 2015. Try to understand that India is a member from the beginning itself in this initiative as a member of G20. So in February 2017, when an ad hoc group was set up with more than 100 countries, India was also a member of it, and after wider consultation, every member country had an equal footing. It was adopted, this convention was finally adopted by this ad hoc group in November 2016. So it was adopted by the ad hoc group in somewhere around November 2016, and so that's the, and finally it was opened for signing to the member countries. And what happened in June 2017, including India, more than 100 countries signed this convention. But try to understand that it will come into force only when many countries ratify it. So under this convention, it says that if at least 5 countries not signing it, so in June 2017 more than 100 countries have signed to it, including India, but if at least 5 countries ratify it, this convention will come into force. Okay, so that point you need to note down. Okay, now while dealing with this convention, there is a very important point you need to note down. Okay, so this convention, unlike this amending protocol, okay, in try to understand that in May 2016, so you need to understand this term called amending protocol. So amending protocol is associated with bilateral tax treaties. India and Mauritius have, through this amending protocol, have made amendment to India-Mauritius tax treaty in May 2016. So when, see, in amending protocol to a bilateral existing tax treaty, you can directly amend your tax treaty. But this multilateral convention is not directly changing your tax treaty, rather it is applied, this multilateral convention is applied alongside the existing tax treaty. Okay, so amending protocol can directly amend the bilateral tax treaty, but this multilateral convention is existing alongside the bilateral treaty, and what it will do is it will only modify their application. It is coexisting with the bilateral tax treaty. It will modify its application of this bilateral tax treaty in order to implement the BEPS measures, this 15-point action measures. That you need to keep in mind. Okay. Now regarding other point is that, see, what this convention will do is that convention will bring consistency and certainty for implementation of this BEPS project in a multilateral context, and it also ensures, this convention also ensures flexibility for a member country. For example, if India is now have signed this treaty, so India have the flexibility. India says that, okay, I want to exclude a particular tax treaty from this convention. So India have that option. So it is flexible in the sense that a member country can exclude specific tax treaty outside the purview of it, and also it can see through reservations. Through reservation, it can say that certain provisions of this convention or parts of this provisions of the convention, we are opting out of it. So you can either opt out of certain parts or provisions of this by asking for reservation, as well as you can exclude certain specific tax treaty. So in the sense that this convention is flexible. So it is consistent, it is certain, as well as it is flexible. Now regarding this significance of June 2017, when India and more than 100 countries signed this convention, what you need to note down is that understand what this, so UPSC can ask what are the advantages of India becoming a member of this multilateral instrument or this multilateral convention. So it will help not only India, other countries, so it will help cross-border tax evasion by multinational companies. That's another one advantage. Second, it will help India to expedite tax dispute. Any tax related dispute resolution can be done expeditiously, mainly in association with this international tax and as well as transfer pricing practices. We will discuss transfer practice in the coming sessions. Okay, now you can say that this convention, in short, you can say that it is a common tax treaty. Instead of going for many bilateral tax treaty, countries in the long term can have a common tax treaty under this multilateral convention. And what this common tax treaty will ensure for the investors. So this is very much beneficial for the investors. For example, foreign portfolio investors. They are now, means it will help them, means now everything is transparent regarding this taxation matters. So it will be beneficial for foreign portfolio investors who invest in the equity market, as well as foreign private equity investors who invest in the shares of an Indian company. So because this common tax treaty is providing transparency. So this is another advantage of this treaty. And one important point you need to note down is that this convention or this instrument, the provision of this instrument would apply to any tax treaty only, for example, India-Mauritius tax treaty. So this convention will be applied to India-Mauritius tax treaty only if both countries agree to it. So this is a very, very, very important point. Okay, the provisions of this convention will apply to a specific tax treaty only if both countries of that particular tax treaty agrees to this convention. Okay. So this is very important point for you. Rest you can read from the material. Okay. So just have an idea, and if a question comes, you can easily answer it. Okay. UPSC will not ask a very tough question because the topic itself is very tough. The UPSC want you to understand that what this convention is all about and what it's basically aiming to. That's all. Thank you.